By cutting rates, did Jerome Powell just screw Gen Z and Gen Alpha? Is Jerome Powell saying it's time to save the baby boomers and screw everybody else? Is that what Jerome Powell is saying? Well, we're going to have a conversation with Mr. Dan Bird, and we're going to get behind the scenes. We're going to talk stocks, housing, interest rates, dollar, all kinds of stuff. But alas, is this about saving baby boomers, Dan, and screwing everybody else? What say you?
I hope so.
Yes. Let me see. What generation are you a part of again?
As a proud boomer, I'd say, yeah, let's go for it.
That is hilarious. But no, I mean, there's some serious take to this, right? Because one of the things that I believed going into this meeting, or actually, let's step back. 2 months ago, I was in the camp of no cuts 2025. And one of the reasons I believe that is I believed we need to keep rates higher for longer so we could extract pain from the market. I believe there's a lot of bad deals. There's a lot of and a lot of this is in real estate. There's a lot of Airbnbs that are
Yeah.
toast, a lot of commercial that are toast. I believe in the stock market. There's a lot of companies that over borrowed and are essentially zombie companies. And I believed by keeping rates high all year, we would allow bankruptcies and the market to heal itself. Markets would reset lower, which meant the next generation could buy assets cheaper. Then 2 months ago, the job market now is a wreck. It was a complete fraud. We've lost 1.8 million jobs in just a flick of a pen. We went from having 157,000 jobs created to negative 19 in June, right? The job market's toast. So then I said, okay, the Fed's got to start cutting. But if I tie those two thoughts together, you could see it as, all right, we're bailing out the boomers and the next generation was hopefully buying assets cheaper. They're not going to get a chance. I mean, you could see that logic. Yes.
I can see the logic based on where we are right now. Yes. I don't think we're going to stay where we are right now.
Well, let's get into it because I think the next generation, or really even all generations, they want to
So
buy
so so
assets
let's so
cheaper.
let's think of that. Let's think of this a little bit differently.
Okay.
If 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 asset prices were to go down,
Mm-hmm.
what else does that imply?
Economy is in bad shape.
Economy's in bad shape. People are losing their jobs. They're not making as much money or not making any money.
Yep.
They're claiming unemployment. So be careful what you wish for. So yes, the next generation would be able to buy assets more cheaply, but they wouldn't have the money to do so
And they'd
unless
be
they're
afraid.
following your channel.
Yeah.
They know what to do.
I appreciate that. There's a lot of truth in that because I keep trying to shake people to get them to understand. I think having survived a couple of recessions, um, I still remember the first one. The first one I lived up close and personal was the dot-com crisis. I was an executive, first line executive, and having to make those layoff phone calls and look at spreadsheets and headcount and all of that was so painful.
Right. Yeah.
It wasn't until the
Yeah.
second
I
one when it
remember. I
pounced.
remember. I was VP of sales of a startup, and the startup basically I had to fire everybody,
Yeah.
and then
Tough,
I
right?
got fired.
Yeah. Yeah. It happens, right? So you're absolutely right. Um, so is this about Powell and the Fed kind of slowing what's inevitable? Maybe I mean, the recessions are inevitable, right? They haven't figured out a way to eliminate them from the business cycle. Is
Right.
he just trying to delay or maybe neutralize the depth? What's going on right now, you think?
I think he's in a tough balancing act right now. He said so on the Q&A session between jobs and inflation, and he believes inflation is going to continue to go up. I think it's going to flatten out.
I think
Frankly,
so too. I think
I
it'll
think
flatten
the
out.
jobs market is going to get worse. In fact, I'm going to show you something
Ding ding ding
that's
ding ding. Damn, we don't normally agree, but we are in sync thus far.
yes, and I'll show you something today that when I looked at it preparing for the show, I was actually pretty shocked regarding jobs.
Oh, let's not hide it for folks. Let's get that right now because I think that's the people ask me, how did you go from no cuts in 25 to the Fed should have cut 50? I'm like, you guys don't understand. This job market is not healthy. So I'm be curious to see what you found.
Yeah, but the Fed says they're data driven and the data hasn't been there until now, right? So saying it before now is just a feeling, a sense, a gut reaction. I think the job market's going to go down, but the data wasn't there until now. The data is there
We'll see.
now.
All right, we'll
So
see.
so yes, they
You've
should.
got me curious.
All right, hang on. Let me share my screen.
Thank you.
For those interested, this is you can see this, right?
Yep, it's up.
My website, breakpointtrading.net. Don't forget the net. My YouTube channel is right up here in the upper right. My newsletter, which we're going to look at today, is just click on this little button right here. You get the newsletter. It comes out every Saturday, usually. All right, so let me show you what I'm talking about. Let's go down here to unemployment rate with continuing claims.
Mm-hmm.
Well, first, let's look at just the unemployment claims, the initial
This
claims.
this is weekly. Yeah.
This is weekly, yes. So here's what will be reported on October 3rd inside this little red box right here.
Mm-hmm.
All right. Notice the big, huge spike.
Yep. Yeah, that was Labor Day weekend.
Bigger than anything.
Yeah, the 263 was the biggest number
for the
in years.
last,
Yep.
in fact, for the last 3 years.
Mm-hmm.
Here's 1, 2, 3, 4 years.
Wow.
The biggest one in 4 years. So let's look at it a different way. Let's look at the continuing claims and initial claims together. The blue is initial claims. Look at that.
Ah, it's increasing.
See that big blue bar at the end? Again, bigger than anything in the last 4 years. And this little line right here is the relationship between the two. So if it's falling, that means initial claims is underperforming continuing claims.
Mm-hmm.
If it's rising, it means that initial claims are outperforming continuing claims. Notice continuing claims has actually dropped.
Yeah, but there's two ways that could happen. Right? Continuing claims, for folks that don't know, can happen. Declining continuing claims happens two ways. One, people get jobs. Two, they give up or they age out.
Right. They stop looking. Right. That's right. So the fact that this line right here, which had been going down, because you can see the blue bars right here, when they go down, this line goes down.
Yep.
All right. So initial claims, when they drop, this line drops. When initial claim starts to go up, now it's actually going parabolic. It's not just rising gradually. Yeah. It is spiking higher. And I've said this all along, that when unemployment starts to move, it's going to spike very quickly.
Yeah, it's an elevator, man. It's not the stairs, it's elevator.
Another way to think of initial claims is it is an indication of layoffs and firings.
Correct. Absolutely.
So when this starts to move up like this, and lots more people are getting fired.
Well, let's ask the big important question for October 3rd, right? That's not next week, but the week after. Are you telling me without telling me that we're going to see the unemployment rate rise from 4.3 to 4.4, which will be a cycle high for years? Is that where we're going? Are we going to 4.4?
Yeah, at least. Could be 4.5 actually.
Oh my God. Did you just say at least?
At least 4.4.
We're October 3rd. At
October
least.
3rd. Yeah, I mean, we're at 4.3 right now.
Well, so, again, folks, 0.2 of a move will get your attention.
All right, so here's the unemployment rate at 4.3. You can go back all the way back here. This goes back to 2021. It hasn't been that high since 2021.
Yep.
All right, let's go back a little bit more. Let's go back 4.5 years. All right, so now we've got 4.5 is right up here. I'm sorry, 4.5 is over here. 4.5 is on this side. This side is the Fed rate. This side is the unemployment rate.
So that's like
4.5 is right here.
Yeah.
There's 4.5 right there.
So
all right, so that takes us back to
21.
September of 21. So like I said, I've said all along, when the unemployment rate starts to move up, it spikes. It goes very quickly. And that's what we could see on October 3rd.
Well, if that happens on October 3rd, you can guarantee, I don't know if guarantee is too strong a word, but you can guarantee a rate cut's coming, but it might be a half. Because again, if you go back to the dot plot, the high of the dot plot was 4.5. And if we get there by October 3rd, watch out, folks. The Fed is going to be in a
So
box.
yeah, so here's October, clearly near almost 100% cut in October. I don't think there's any question that's going to happen. That's a 25 basis point. The next one though is split between December and January. So I can absolutely see one of these getting moved forward to October.
Yeah, one of these doubling up. Absolutely.
And so I think your 50 basis point cut in September was just a little early.
I think you're right. I will. Again, I'll go out on a limb. I love to do this. If we get a 4-5 October 3rd, I believe the Fed has no choice but to go 50 in October.
Yeah, I think that's probably right. And here's the dot plot, which is pretty interesting. Actually, I have this little magnifying glass that I'm playing with now. Oh, look at that. Okay, here's a most recent one. Look at this one way down here. What the heck's that little guy doing? Way down here.
That would be the brand newest member of the Fed trying to placate Trump. That's what that is.
Yeah, I know. But what it does though is it throws off the math slightly, not a lot.
Well, yeah, but
you can see the red dot. The red dot is the mean. The red dot right now for the rest of this year, for the end of this year, is right about 3.5.
Yeah,
which is
2 more cuts.
Which is 2 more cuts, right? And then next year, you can see that the mean right now is way down here at 3.
Wow.
So, and it likely is going to be lower than that, frankly, I think.
I think so too. I think it's going to 2.5.
Yeah, very well could.
Yeah, but let's talk about, because I want to go back to that chart, because one of the things I'm trying to get people to understand is the Fed is a complete mess. And I want to focus on 25, because we joked about Moran or whatever his name is being the low. I want to talk about the high. Mm-hmm. There's somebody in the Fed that thinks we should raise rates.
Yeah.
That's what that means.
Yeah, I know. That's not going to last, though.
But to my point, the Fed is a complete disaster. We've got one person that says we need 150 basis points. We have one that says that we should raise rates. We got 6 that say we should do nothing. And we've got 9 that says we should cut 2. I've never seen such a divided Fed.
Yeah. I mean, that's because we're right on the cusp. Like I said, it's a balancing act between inflation, but let's talk about inflation for a second. And we've talked about this many, many times before, but we'll look at it again. CPI and the base effect. So here's the next one.
Yep, starting to get a
little bit bigger. Last time, came in at forecast 2.9, came in at 2.9.
Yep.
The next one is a little bit bigger. Probably going to stay right at 2.9 or might go to 2.8. But then we start getting big ones. So here, this is we had September here. So here's October, November, December, January, February. Huge.
Yeah, they're big ones. Yeah.
December, January, February. The CPI reports huge downside on CPI.
Yeah. So I remember we talked months ago, and we thought by March of next year, inflation could be pretty close to 2%. Yeah. Would it be better to say now close to 2.5? Or you still think 2?
No, I think it's going to go down rapidly. I think it's going to be below 2.5. It might not be at 2, but I think it'll be below 2.5 by the end of the year.
By March. Okay.
Right. Now notice the trend line. This trend line goes back, more than a year, almost 2 years. This trend line right here. Uh-huh. It just got broken with the last CPI number, 2.9. Broke the trend line, which means it's starting to go up again.
Got it. Okay.
So anyway, inflation is not the issue. I have said over and over again, many, many times.
Yes.
I'm starting to be proved right finally that tariffs are not inflationary. And I'll say it again, tariffs are not inflationary. So that's being proved out right now. In fact, did you see the last report from the OMB?
I'm sure I did, but let's remind
Office of Management and Budget, that the last time when the big beautiful bill went through, they said it's going to cause something like $1 trillion in deficits.
Yep.
Well, they just revised it. They said, oh, we didn't really think about the effect of tariffs, so we've revised it now. We now have a $300 billion surplus.
Shocking.
Surplus.
Yeah, that's a good thing. Yes.
That's a good thing. Yeah, that's what tariffs do. So anyway, that's pretty interesting. It's going to be interesting to see what happens. I think that your 50 basis point cut is just 1 month delayed.
Yeah. Yeah, I
I think
so.
we likely will get it in October. We may not get one in December.
Yeah, if we go 50 in October, that might be the pull forward. I agree with
Right.
that.
And they usually don't like to cut just before Christmas anyway.
Okay.
So I think we probably will get a 50 basis point cut in October. What does that do for the market? Well, let's go back to my newsletter here. I talked about a lot of this. Here's the 10-year Treasury actually went up after the rate cut.
Yep.
This is a weekly chart. Trying to figure out how to use this. Trying to figure out how to use this magnifying glass.
New toy.
Yeah, it's somewhere in there. Anyway, whatever. Anyway, it went up just like it did last time. Yeah. So the bond market is saying, yeah, great. So here's actually the lines right here. So here's a 50 basis point cut right here.
Yeah, rip tire.
Then there's a 25 right after it.
Rip tire.
And the 10-year kept going up. So we got another 25 right here. Will the 10-year keep going up? It looks like it probably will.
Yeah, we'll see.
What happens when we get a 50 next month? That's the big question.
That's the big question.
There's the 12-month rate of change. All right, here's the Japanese spread. Spread actually is just hanging out right on this line right here. It's about 2.35. That's the support line. If it drops below that, some people asked me questions when I mentioned this last time we talked about the Japanese spread, that if it really starts, Japan has decoupled their yield curve control, so they're letting their yields rise. So what that might mean is that there might be a repatriation of money out of U.S. assets back to Japanese assets.
Yeah, for sure.
But I don't think that's going to happen until we get down here to this next support line at 1.7. Okay.
So it's between those two lines is where the pressure.
Right, somewhere between there, we got to start worrying. I don't think we have to worry yet.
Okay.
Put call ratio still very bullish. When it gets below this line right here, it's extremely bullish. That means everyone's buying calls. Nobody's buying puts. Nobody ever thinks the market's going to go down again. That's the time when it usually reverses and we get a sell-off. And it's not there yet, but getting close. Same thing with the percent of stocks above their 20, 50, and 200 moving averages. Even as the market continues just to hit new highs, all-time highs, this continues to go down. That means there's very little participation in that rally. This one here was really interesting. This is another one that kind of shocked me when I looked at it. I put it in the newsletter. These are the new highs versus new lows for the NASDAQ 100.
Oh, that's interesting. I would not have guessed that.
Yeah, so big, huge move. Look at the volume. The volume on Friday is not surprising. That's options expiration. So that usually is what happens.
Okay.
But the volume the day before was huge volume. Up day, I mean, it ended pretty much where it started, but it was an up day. It's a green bar. And the new highs actually went up. So that's what you should expect to see when the market goes up. But what happened Friday? We actually hit a new high and it ended the day near the high of the day. But there were a lot more new lows than there were new highs.
Yeah, that seems weird.
Well, it's not weird if there are only a few stocks moving the market.
Oh, we're back to concentration.
Right. If all you have is a few AI stocks that are pushing the market up, and quantum stocks were on fire.
Got it.
Thursday and Friday. I mean, actually all week, quantum stocks were on fire. All the AI stocks were on fire. So that trade is continuing. But if those are the only ones that are participating, then you've got a lot more new lows down here.
That makes sense.
That should be concerning.
Yes.
The other thing that I noticed, if we go back to July, early July, this was the largest bar right here for new highs. So this one right here, right at the beginning of July, we had the biggest new highs, the most new highs in this whole period. Then the market continued to go higher. But what did the new highs do? They came down, even when the market spiked to a new high again, right in here. These went up also, but not as high as early July. And then when the market spiked even higher,
Mm,
the new highs were even lower.
got it.
So it keeps going down. And this one right here is pretty much where we hit twice after this.
Okay.
So right here, market was going up. It was pretty much getting ready to break out, pretty much even from this one here. We hit the same number of new highs. Market went up again, hit a new high on Thursday, hit that same level. It couldn't go higher. It has not got back to this early July. And then Friday, of course, it just fell apart. And McClellan is a moving average of the advanced decline lines. So the top one is the NASDAQ. The bottom one is the New York Stock Exchange. You can see they're both very weak. Yep. So even as we're hitting new highs, it's on fewer and fewer advancers. Again, concentration of a few stocks. This is where I use my noodle toy.
There you go.
So this is the secular bull market from 2009. You can see the channel that we've been in. Mm-hmm. The halfway point. Here's COVID and went down to the bottom. Right. So we hit the halfway point. Each time it bounces higher. This one went through at COVID. This is 2022 right here. This is in April.
Yep. Liberation
February to April of this year. You can see it blowing up over here on the right-hand side. So this is the channel since 2009. This is the trend line on the highs since before the financial crisis. So that was the high before the financial crisis. This was the next high. This was the next high. So that's the trend line for that. That's the dark red one. So here's the blow up. There's the blue one and the red one right there.
Yep.
And remember, August and September are usually the weakest months of the year. So this is a monthly chart. So this last bar is September, which is not finished yet. Mm-hmm. But this one before it is August. And we've got 4 months of green bars right off of this low right here. Nice. We're now above all of the trend lines. There is no overhead resistance. There's nothing to stop this market from going higher. And what did I predict the S&P would be at by the end of the year?
6,800?
7,000.
Oh, 7,000. My bad. 7,000. We're still going there?
I think we have a good shot at getting there. Yeah. Well, I mean, we're at 6,700 now.
Yeah. Okay.
So it's not that far away.
We got to wrap this one up quick. We both have time commitments here. What's the closing thought as we wrap up this call?
All right. Before we do that, let me real quick. We got 5 minutes. I'm going to show you. I'm going to give you a teaser to maybe help you read my newsletter every week.
There you go.
Down at the very, very bottom, I accumulate all of these little charts through the week. I see these and I copy them. I'm going to just focus on the real estate ones.
Okay.
So they're speculators, not much change. They're all short. Housing starts. Housing starts is declining.
Oh, yeah.
Trend softened in August, falling back into negative territory. Number of multifamily housing units under construction rolled over in August.
Collapsing. Yep.
That's multifamily.
Yep.
Michigan, let's see, tariffs, not inflationary. These are the leading economic indicators are negative. Consumer expectation is down. Sentiment is souring. Investors are pulling back. There's employment, Russell 2000. I got a couple more. Here's the home builders right here. So home builders outlook for sales, which is the blue line, and prospective buyers traffic is the orange line. Latter is still quite weak.
Folks, at the end of the day, you've got to get this newsletter. You get it at breakpointtrading.net. He works.
There's 30-year mortgage rate rolled over, which is interesting. 30-year actually rolled over. We had a record number of refis. Mortgage applications soared by 29% last week. That's what it looks like. And then down at the bottom, population growth is declining. These are just some interesting things. Truck sales usually happen before a recession. Yep. Florida has the highest insurance rates, natural gas reserves, bank interest rates worldwide. Turkey, go to Turkey and put it in a savings account. You get 43%.
It's crazy.
Older generation, Florida is the biggest one, naturally. States requiring front license plates. Did you know this?
I did not.
All states don't require a front, like Florida does not.
Huh.
So the red ones require a front plate. The yellow ones do not.
Huh.
Interestingly. Oh, yeah. And here's the last one. This is the one I'll leave you with.
Pokemon cards.
Pokemon cards are outperforming everything. So don't buy
Pokemon cards
Meta.
Are the best asset.
Don't buy S&P. Don't buy Bitcoin. Don't buy gold. Buy Pokemon.
All right, folks. Well, we will leave it there. Always fun, Dan. You do amazing work. Check his website, YouTube channel, newsletter. It's all good.
ThreePointTrading.net. Those little tidbits I'm trying to put those in every week in the newsletter right at the very end. So they're always fun to see what's going on there.
There you go. Dan, you're amazing, bud. Take care. Thanks again.
All right. Have a good week. Take care.